Welcome to our exclusive webinar entitled The Future of Investing, AI-Driven Risk Management by Sanlam. My name is Don, and I'm thrilled to guide you through this insightful session as we explore how artificial intelligence is transforming the landscape of investment management. In today's fast-paced and ever-changing financial markets, managing risk is more critical than ever. The Sanlam AI Managed Risk Fund leverages cutting-edge AI technologies to provide robust, data-driven solutions designed to optimize risk-adjusted returns for investors. Over the next hour, we'll cover an overview of the fund and its investment philosophy, how AI and machine learning technologies are applied to risk management, and the fund's performance metrics and its potential role in a diversified portfolio. We are honored to have Gideon Nell of Sanlam Investments and Alessandro Di Soccio of AI Machines joining us today. They will provide a deep dive into how Sanlam's AI solutions are leading the charge in delivering smarter, more resilient investment outcomes. So without further ado, let's dive into the journey of how Sanlam is redefining risk management with AI. Over to you, Gideon.
Thank you, Don. And thank you for the opportunity to speak to you. I believe most people on the call are advisors, so we'll pivot the language maybe a little bit towards that. If there are clients, it will still be natural to you, but there's obviously a majority of advisors on the call. So firstly, you saw, and I know Don mentioned Alessandro, he will introduce himself a little bit later. He's the co-founding partner of AI Machines, and he'll speak about what they've built and why they've done it and how it operates. We'll give you a good high-level overview. And of course, in the Q&A section, if you want to ask deeper questions, feel free to do so. And as Don said in the chat box, please stick in your questions. We'll probably cover them at the end. Happy to make it as interactive as you want. We're going to try and do this in about 20 to 25 minutes. So maybe it might feel fast, but admittedly, I think we'll focus on very specific points. To start with, and at the end of the day, you need to have a why for what you do. And we think this statement from Albert Einstein in the 1950s, we cannot solve today's problems with yesterday's solutions, pretty much encapsulates not only what AI Machines does, but very much what this fund represents. So what is it solving for? Now, admittedly, it solves for many more things. And I took a stab, as you would say, and just to reduce the number of things we focus on today, because I think it's probably most relevant to this audience, but it solves many other things as well. So firstly, if you or your investors are looking for a smoother investment journey, and if you're looking for the potential for real better outcomes in total return terms, and if you may be concerned about liquidity or leverage or currency risk in a fund or in your portfolio, this product addresses those things very well. Obviously, we'll speak about these things. And then if you're looking to diversify your existing human manager risk, you probably haven't heard too many people use those words before, but that is the reality, because humans, especially in the multi-asset space, to be honest, even in the sort of straight equity space and bond space, tend to do similar things. And especially in the multi-asset space and asset allocation, strategic asset allocation, they follow very specific formats of what they do at the heart of what they do. The AI does not, follows a completely different process, and we'll speak about that. And then in my personal opinion, I started the industry as a stockbroker, became a wealth manager, so an advisor, before I went into asset management sales when I moved to the UK a long time ago. I actually think the last point here is the key point of the whole product, but that's my opinion, because that's a solution in terms of suitability. So if a client is cautious or balanced risk profile, but they're looking for something more aggressive, growthy return profile outcome, then this is worth to look at the Sanlam AI Global Managed Risk. So this is a next generation global tactical asset allocation fund. It's a UCITS fund. We'll speak about liquidity and those things in a few slides. But it is UCITS, and if you're familiar with UCITS, that is the most acceptable fund vehicle, literally on the planet, actually. And we very much want people to view this as a product that serves as your alternate all-rounder core portfolio solution. And we'll explain what we mean by all-rounder. in a few minutes. Just to paint a picture of who's behind this at a product level, and then obviously the management of the product. So firstly, the administrator and custodian is Northern Trust, different parts of Northern Trust for legal purposes, but it is Northern Trust, and they're largest, I'm guessing you're familiar with it. They are one of the largest financial services groups in the world. They have got $17.5 trillion of assets under custody and administration. And as this fund is domiciled in Ireland, under UCITS rules in Ireland, we use Irish service suppliers, and the lawyers are Maples and Calder. If you're not familiar with them, they are literally, I don't know if they're the largest, but they are absolutely the most known and most prominent player in the fund industry in Ireland. And then everybody will be familiar with KPMG, who's the auditors of the fund. Zooming in a bit closer to the product itself. So the manager of the product is Sanlam Asset Management Ireland. It's a 100% subsidiary or 100% owned subsidiary of Sanlam. If you're not that familiar with Sanlam, Sanlam's the largest non-bank financial in Africa. And I often just describe it as the Alliance of Africa because it does everything in financial services except banking, very much like Allianz. But it's the largest in Africa. It does business all over the world, but it's African domiciled, Cape Town based, headquartered. It was founded in 1918, so about 106 years old now, and over 110,000 employees, over 69 million clients in 31 countries. We have clients already actually in the Philippines as well, but that doesn't count under that country count because it is based where we have operations, those numbers. We have over 70 billion assets under management, dollars, and a market cap of over $8 billion. It's listed on the FTSE Johannesburg Stock Exchange. And we also have an ADR listing in New York. And the group is AA+ rated by Fitch and have been for as long as I remember. I've been with the group for 10 years, so I didn't introduce that part. From this accent, obviously, I'm South African, born and bred, but spent 15 years in London. And I moved to Lisbon about 10 years ago. And I look after EMEA, so Europe, Middle East, and Asia. And there's need to be stationed on the ground when you work in Europe from a compliance perspective. The investment signal provider, which is really where the magic happens, is AI Machines. And as I said, we've got Alessandro. Alessandro, please introduce yourself and your firm and ultimately Pi and why you do what it does. And the next slide is you can describe Pi itself. Thank you.
Thank you, Gideon. Thank you very much for the introduction. Thank you, Don, for organizing this. My name is Alessandro. As Gideon said, I'm the co-founder, co-CEO of AI Machines. I spent the last 27 years in London, United Kingdom, and the last 15 at the intersection of asset management, trading, and machine learning. Prior to AI Machines, I worked for Citigroup, again in London, proprietary trading and client unit with over the $50 billion of unlevered capital under management. Before that, I worked for a US hedge fund group with $5 billion in assets, and before that, I worked in mergers and acquisitions. AI Machines is a financial technology company that develops and operates artificial intelligence and machine learning solutions for investment management. We have created an end-to-end, fully integrated investment and risk management software engine that does everything from an asset management standpoint, from data processing to asset price and risk prediction, in order to manage any type of portfolio. The software that we have developed over a 15-year period now has almost an 8-year track record. For this product, the track record is 7.5 years. The software is called Pi. Pi is a predictive investment and risk management software engine that integrates multiple machine learning technologies and methods into a single fully automated operating system. The operating system combines data processing, predictions, and the risk management component. The key features of the software is that it is able to eliminate, as Gideon says many times, emotions. However, this is done by any quantitative method. In particular, it is able to eliminate biases from the decision-making process. It provides an exponential amplification of analytical capacity and is able to learn autonomously from data. As it is 100% based on artificial intelligence and machine learning, is also able to adjust its hypothesis as markets change and evolve and predict asset price behavior, and in particular is able to dynamically minimize portfolio drawdowns. If you want to visualize the engine, it can be seen really as a large proprietary trading desk of a bank, but with the ability to amplify enormously the analytical capacity of whoever is involved. If you think about a trading desk, you think in terms of researchers and analysts, traders, a head trader, and a risk management. This is pretty much the same. However, what it does at the end is to generate superior investment outcomes from a risk and return perspective because of its ability to amplify the analytical thinking behind the investment process. The processor here fundamentally covers the function of research analysts. The processor is represented by different type of data processing methods that take data from the market, transform the data in different ways in order to make it more interpretable, easier to understand from an analytical standpoint. And once this data has been transformed in order to be detrended, rescaled, and to also remove some outliers, is passed on to the predictors. The predictors can be seen as the traders in a proprietary trading desk. The predictors are based on self-learning, adaptive algorithms that look at the transformed data and generate hypotheses about what the market is going to do in the next 5 trading days. Please keep in mind that with respect to the Sanlam Global Managed Risk Fund, the overall goal of the engine is to determine on a weekly basis the correct net exposure of the fund that can go between 10 and 90% in order to capture a good percentage of the upside whilst controlling dynamically portfolio drawdowns. So with respect to this, we have 600 self-learning adaptive algorithms that analyze the behavior of the S&P 500 and the MSCI World. The S&P 500 is used as an edge, so we sell a certain amount of short futures every week in order to adjust dynamically the exposure that you have in global equity markets. Once the predictors generate their hypotheses, these hypotheses are then analyzed by a head predictor, which extract one single signal per asset. So out of these 600 hypotheses, one signal is generated which capture the essence of the 600 hypotheses. And then it's passed to a risk manager. And the risk manager, which is obviously based on artificial intelligence methods, is considering the right size of the trade. So it's not just about the side of the trade, what the market is going to do in the next 5 trading days, but it's also about the size of the trade. So the risk manager is looking at the various predictions and is saying, okay, now I will look at one way to generate an optimum weight, which is essentially the net exposure, is fundamentally the number of contracts used in order to adjust dynamically the net exposure, is the optimal weight, in order to capture a good amount of positive return. However, my main goal as a risk manager is to dynamically adjust and minimize the potential shape, the expected shape of portfolio drawdowns, which is fundamentally how we perceive risk. We do not perceive risk in terms of volatility, but we perceive risk in terms of expected portfolio drawdowns. Drawdown, in fact, is not a single number, but is a sequence of returns that can take a portfolio down, can keep a portfolio down for a certain amount of time, and might not allow the portfolio to come back up. So the overall goal of the risk manager is to minimize the depth, to minimize the length, and to increase the speed at which your portfolio returns come back up.
Thank you, Alessandro. We do actually have a slide regarding. Sorry, did somebody speak?
No.
Okay, we do have a slide regarding drawdowns and the shape of drawdowns, because this is the key, probably the key part of the engine, especially from a performance attribution, risk management attribution perspective. So we can speak about that if anybody's got questions regarding that at the end. But thank you for that, Alessandro. So I'll go more specifically into the product, how it operates. Alessandro has already mentioned quite a few things about how it operates. And then, as I said, we will address your questions at the end. Now, if I can get the slides to go across, that would be useful. There we go. So the product philosophy, which is very much also engine philosophy in many ways, but the product philosophy for this fund, the AI Global Managed Risk Fund, is that investors' risk is capital loss. That's the real risk. And specifically in terms of capacity and time and losses, Alessandro just actually mentioned, not volatility. And the reason why it's not volatility is, you'll all be familiar with, say, a standard balance fund will typically have about 10% volatility over time. But then you have significantly bigger drawdowns when things go wrong. If you take the global financial crisis, average drawdown across the balanced category, moderate category, depending on the naming of the database, was about 35%. And that's the problem for a lot of clients, because a lot of clients think, they look at a product, they see a volatility number, they go, oh, my risk is 10%. And then they have a 30% or 35% or more drawdown, panic, don't believe their advisor, and sell, and the relationship is ruined. And that's core to what this product does. The whole idea is trying to get people invested and keep them invested, because as we all have seen, numbers over the years, it's when you stay in the market. It doesn't mean you stay blindly all the way into the market, but that's the whole point of this product. But that you actually just stay invested versus going out, because we know that clients go out at the worst possible times and come back at the worst possible times far too often. Second point of the philosophy, which is really not a philosophy, it's a fact. Equities typically outperform all other asset classes over a market cycle. So market cycle just being a bull and a bear market, doesn't matter which one comes first. The combination of that is obviously called the market cycle. And I've seen numbers going back, I think that was from Goldman Sachs, to 1900. It is always equities that outperform all other asset classes. And then cash is the only risk-free asset. I know sometimes people say US Treasuries and a few other government paper is risk-free, but it's not, because US Treasuries can have 20, 25, 30% drawdowns, again, like we've seen a couple of years ago. So cash is the only risk-free asset, and hence why we use those two. Asset allocation is number one driver of portfolio returns and risk. I should actually include that, but from the purpose of returns, it is the number one driver of returns. And there's quite a lot of papers that talk about that as well. It's not picking one stock. And I know if you own NVIDIA, then of course you can have a great time, or you feel like you're having a great time now. But over time, that one stock doesn't make your whole portfolio perform better than being in the right asset class. That's why asset allocation is so key. Asset diversification. This is strategic asset allocation. The free lunch that a lot of multi-asset managers will speak about, which used to be a free lunch for decades. Professor Markovich's work started in the 50s. He got his Nobel Prize in the late 80s for the efficient market hypothesis. But the reality is, since the turn of the century, when equities fall, everything falls, maybe in different degrees, some more, some less, but they all fall, they all correlate and fall together. And that's a bit of a problem these days. And the last point, which is a logical point to include in this, and as Alessandro referenced, human emotions and behavioral biases often impact investments negatively. So the product proposition is, this is a next generation global tactical asset allocation strategy. It is 100% driven by artificial intelligence, and it operates without emotion or behavioral bias. And it's there to help you diversify your existing human manager risk. We're fully aware that people will own something like a BlackRock global allocation, theoretically actively managed. The underlying is certainly is the asset allocation less so, or something like a Vanguard balanced ETF, which obviously the underlyings are just ETFs, but the whole thing is, again, the asset allocation is static, strategic, but ultimately static. This is very much active. So it proactively allocates between equities and cash, being your top performing asset over a cycle and your risk-free asset. It does that to help you smooth your investment journey, or your investment journey. And therefore it carries no risk associated, or direct risk associated, with the bond market, the property market, and the commodity market, being the other three broad asset classes. It's daily dealing, single priced, no weird things in those terms. There's no notice periods. It is as liquid as it can possibly be. There is no leverage in the product. And the reason why there's no currency risk is because we hedge out the currency risk. So the base portfolio is all in dollars, and all the other non-dollar based share classes are hedged for their relevant currencies. And again, back to the point that I believe is the biggest value in this product, which is this serves as a very unique core portfolio solution that you can sit alongside your Vanguard and your BlackRock global allocation if you want to start like that, because it offers suitability criteria that you can match across the investment risk spectrum. And if you look at the blue points at the bottom, it has had a stronger total return profile than aggressive, a similar volatility profile to balanced, a similar maximum drawdown profile to cautious. Those first three being outcome, tolerance to risk, and capacity for loss is language used by regulators all over the world. I don't know what it's like in the Philippines, but it would be something similar. And that's how you suit your clients. And the fourth one, which regulators haven't clicked onto yet, it's one thing going down, but it's another thing not coming out fast enough. And so your time and your drawdown is a key point, and this has got a shorter time and drawdown across aggressive, across balanced, and across cautious. The portfolio is extremely simple. As we've mentioned, there's only two asset classes, equities and cash, but it's further simple because there's only three instruments in the portfolio. There's a 90% global equity tracker called the Sanlam Satrix World Equity Tracker, but it's managed by BlackRock, and it tracks the MSCI World just like any other tracker, and it really does track it extremely accurately. And as I said, managed by BlackRock. So 90% is static in that all the time. 10%, the other 10% is just in cash. And the reason for that is if you go more than 90% equity exposure in a portfolio, the databases tend to put you in the equity category. And what we wanted to give clients here is the highest possible equity exposure, but still remain a player in the multi-asset space and the asset allocation space. And the reason why the 10% is the low end, why there's 10% in cash, is you typically don't get less than 10% equity exposure in a cautious fund. So what we wanted to give investors is a single product where they can move from being 10%, the least you can get in a cautious fund, normally in equities, to the maximum you'll get typically in an aggressive fund, and that whole range. And the way we move between that 10 and 90 is, instead of selling the underlying, which UCITS rules don't allow you to do with the way the fund is set up, to have only three instruments, we short S&P 500 futures. They're called E-mini futures. It is the most liquid equity future in the world. Go check it out for yourself. And we short between 0 and 80, because by doing so, if you subtract between 0 and 80 off 90, then you get yourself at a number between 90 and 10, obviously. And to think of it very simply, it's as if you're driving a car and your foot's on the accelerator and you're going 90 kilometers an hour. But on board your car, you've got something intelligent that can look forward and make a prediction. And it will look at the weather and the road quality and whatever else. And it will say, you know what, it's a beautiful day. The weather looks good for the next week. You can go 90 kilometers an hour. And at that point, there'll only be two things in the portfolio, being cash and this equity tracker. Or the AI might say, you know what, might look okay now, but looks like there's a bit of cloud building, looks like there's a bit of drizzle, roads not so smooth. Let's go 50, and it will short 40 futures to get you to the 50 mark, and you're going 50 kilometers an hour. Or it might say, you know what, there's gale force winds, it's very dark clouds, there's thunder, the road is full of potholes. We go as little as possible. We still want to move, but we go as little as possible, and it will short 80% of the portfolio in S&P futures, and that will make the vehicle go at 10 kilometers an hour. And that is as simple as this product is. I mean, I would argue that I've not seen a more simple portfolio in the multi-asset space in my life, and I don't think it exists, actually, to be honest. So this is all very tactically done, as we've mentioned, 52, one decision a week, so that's 52 a year, executed on a Monday market on close in New York, and that competes versus the 4 decisions made by a normal multi-asset manager, which tends to be a rebalance, not really an asset allocation decision, and that happens typically at the end of each quarter. And again, it's 100% driven by a self-learning and self-evolving AI engine called Pi. So what does this look like from an output perspective? So here's the net equity exposure. You can see a 90 and you can see 10. Since we've put Pi in charge of the fund in June 2017, and you can see here it was knocking around the top near 90% for quite some time. It made beautiful calls in that February. I'll never forget it, because that was the first time there were big, calls going risk off made, which made everybody very excited. But we've lived it for 7.5 years now, so we're quite used to it by now. And you can see how it's not scared to go back up and come down again. And very interesting, this year it's kept it quite stable. And then recently we've seen a few 10%ers actually, and at the moment it's at 59%, just for your information. So what does that output lead to in terms of performance? Well, I spoke about the stronger total return than aggressive, and there you are. The dotted blue is the fund, has done 66%. Aggressive has done, where's my eyesight, getting a bit older. I think is that a 51, Alessandro? But importantly, balanced, which Morningstar calls moderate, have done half of that basically at 33%. And you only got 20% in the 7.5 years from your cautious, which is not a great outcome. As we've said, volatility, very similar to the balance space. And if you go to the drawdown profile, very similar to cautious, and recently significantly less and quicker out as well than cautious. But there's a single slide that encapsulates this very nicely. So here's just total returns, medium term, 3 to 5, and since inception, which is 7.5 years for this. Doing very nicely versus the aggressive space, needless to say, significantly more delivery versus cautious and moderate. And very similar volatility, standard deviation to balanced, very similar, albeit a little bit less, maximum drawdown than cautious. But what really matters is this, 2 months to get to the low point in the drawdown, 11 months to come out, and have a look at what everything else did in its time to go down, and then in its time trying to come back out again. And obviously all of that just helps clients have a far smoother investment journey. I'm probably not going to repeat these points because I've only said them a few minutes ago. It's just a summary of what we discussed. Maybe what I haven't discussed is the fund is A-rated by MSCI ESG ratings, if that matters to your clients. It's 5-star rated, and it's been 5-star rated by Morningstar for a very long time. And it ranks first percentile in its Morningstar category, but that's only a part of it because it actually plays across all categories. But of course, Morningstar can't put a product in all categories. So I'm going to pause there and go to questions. Let me see if there's already questions posted, which I don't. Don, if you can see any that I'm missing, let me know. Otherwise, honestly, just feel free to ask. I don't know if people can speak, if it's just us that can speak. If you can't speak, then obviously please post your questions in the chat box. Otherwise, Don, take the lead and ask away.
Thank you for that, Gideon and Alessandro. I actually have a few questions that compiled prior to this call from the advisors. So here's one. What is the maximum drawdown of the fund, and how does this compare to similar funds? How does it work in terms of drawdown?
So here's the drawdown figures. This is the inception of AI being in control. The fund has got a longer track record. I just excluded it because people want to see what the AI have done. The strategy never changed. The strategy is still the same. It's just the brains behind the strategy used to be human written algorithms, and the human had to rewrite them as you do. As algorithms start failing or not being relevant in a specific time anymore. And then in 2017 June, the AI algorithms were put in charge, the engine, and it rewrites its own algorithms. So and it learns by itself. It is truly autonomous. But so I've only got numbers. Actually, I have longer numbers, but I'm guessing it's at the back of the pack. But there you can see the drawdowns versus cautious versus flexible, balanced, or moderate, as Morningstar calls it, and aggressive. But that is just the drawdown number. Again, we'd like to focus your attention to this section, because that's when you're going down and how long you take to come back out again. Because during that period, the clients are negative in returns, but also in psychology and in emotions. And that's where the relationship becomes sticky. And we're trying to solve for that, obviously.
Right.
I would add, Don, that the drawdown that Gideon has just shown is the maximum drawdown, which, when compared to the Morningstar conservative, is sort of similar, lower but similar. So for GMR is -12, for Morningstar conservative is -13.8. However, the maximum drawdown is a single number that has been generated over the period June 2017 to November 2024. But the fund, like any other fund, experience multiple drawdowns over its existence, okay? And only one is the maximum drawdown. You could have many more others drawdowns that are not as deep as the maximum drawdown, okay, but are still painful. So when you calculate the average of all these drawdowns generated by the fund, the average of all drawdowns generated by Morningstar conservative is -9.4. By Morningstar moderate is 11.9. By Morningstar growth is 11. For the MSCI World is 8.3. And the GMR number, in terms of average of all drawdowns, is 3.6. It's 3 times less, okay? So when you look at all the different drawdowns and you calculate an average of all of these, the average drawdown of GMR is -3.6. The average drawdown of Morningstar conservative is -9.4. So when you look at the maximum drawdown, it's 13.4 versus 12.4 versus 13.8. But when you look at all the drawdowns and you calculate an average of that, is -3.6 versus -9.4. This is key, because when you look at risk-adjusted returns, you don't have only the Sharpe ratio and the Sortino ratio, but you also have other things, one of which is called the ulcer index, which is called ulcer because it generates pains in the stomach for traders and investors. And that's the reason. So when you look at the annualized return and you divide that for sort of a number that capture both the depths and the time in length, which is the amount of time that you spend in drawdowns, the annualized return divided by the ulcer index for GMR is 1.7 versus 0.5 for conservative, 0.65 for moderate, and 0.83 for growth, and 0.6 for flexible. So what it does is smoothing the equity portfolio curve. The goal is to capture a high portion of equity world returns. However, avoiding, and not completely, but by smoothing the equity portfolio curve is producing a safer, more enjoyable investment time for investors, which tend to have an allergy for deep and prolonged underwater periods. Underwater periods means when the star goes down and stay down. That's an underwater period. And once you experience that, it always takes time to come back up to the previous highest point. Okay, so the fund is capturing equity world returns and is generating an investment profile that is safer and more enjoyable for investors, traders, and also advisors.
All right. So another question here. How does the AI-driven strategy adapt during period of high volatility or market downturns? Let me give you an example. Remember the what do you call this? COVID, during the COVID sell-off, markets fell. What, 30% or whatever, right? This strategy, this Sanlam fund, you mentioned that every week you position on the market every Monday, right? So what if the sell-off happens on a Tuesday, Wednesday, or Thursday? What would be will the AI adapt during the sell-off, or just let it pass and position on the next week? How
That's a very important question, Don, and you picked a very good and smart period, I must admit. So the investment time frame of the fund is 5 trading days. Okay, so what it does is reconsidering all his positions every 5 days, from Monday to Friday. Then the software look at all the various hypotheses, is reconsidering the decisions taken during the previous week, and it might confirm or not the previous week decision. Then the trades are passed on to the trading desk, which execute the trades on a Monday close. Now, as the investment time frame and the forecasting horizon of the fund is 5 trading days, once you have taken those decisions, you wait for the next available decision-making point, which is another 5 trading days. With respect to what happened at the very beginning of the decline, I would say that look, there is a trade-off over time between trading more and trading less. Okay, so you could say, why doesn't this fund have daily time frames? Okay, daily forecasting horizon, because inevitably you will be trading more. Okay, so you have to consider then the trade-off between more trading, more transaction costs. It doesn't necessarily mean that you're going to get it right all the time. So the path could be slightly different. With respect to that moment that you indicated, the decision was taken by the software to confirm the previous week. And the decline started actually, if I'm correct, the decline started on a Monday afternoon, which means that and actually it happened fast. So from Monday to the whole week, it happened fast, which is once again one of the many dangers of the markets today. So once the decision was taken during the weekend, based on all the previous data considered over the week and all the previous weeks, then you take that decision. And unfortunately, in that moment in time, it meant that fund experienced that drawdown during that week and could only consider the decisions again at the end of that week. You have to consider, Don, that this fund already takes 52 investment decisions a year. When you take in consideration the I would say average, but in general terms, I would say the vast majority of asset allocation funds in the market, they only reconsider once a quarter, okay? And when that time comes, you have a portfolio manager that is literally overwhelmed by the amount of data in the market and by the variety of data in the market and by the way with which this data changes, which is the velocity of changes in data. And what happens every quarter is that most of the times they actually just confirm the previous investment decision that they taken in the previous quarter. So even if in theory they are able to take 4 investment decisions a year, the reality is that those decisions are pretty much always around the previous weight decision. Okay, so they don't change too much. And in fact, strategic asset allocation funds, I call them static asset allocation strategies because they don't change too much. So this fund instead not only takes 52 investment decisions a year versus the conventional 4, but it has the ability to literally switch from 90 to 10 quite quickly, as you have seen before in the slide that is related to the net exposure. One of the weaknesses, probably the only weakness that can be identified is that, yes, you can be caught in a very sharp declining market. Once you've taken that decision, you have to wait the next available decision, whereby all the data is reconsidered, analyzed, and the various predictors and risk manager would then decide if it is time to confirm the previous decision or change the net exposure and reduce the risk in that case.
Alessandro, I just want to add something here because it's important, and even we've forgotten because time moves on. When we looked at putting AI machines, or Pi more specifically, in charge of the fund, we obviously looked at different time frames for decision making. And the reality is, though, that a bear market doesn't last a month normally. I know it did essentially in 2020, but that is not the time of a bear market. Bear markets last on average between 1 and 1.5 years. So whatever may happen in a week, I'm genuinely not concerned with that. Secondly, the AI was exposed either 87 or 89% in February 2020. And it did ratchet over 3 weeks. It did ratchet, I think it went to somewhere in the 50s, then into the 30s, and then to 10%. So it ratcheted down to 10%, saying there's a huge amount of risk in these markets, and we decide to get out of it. And of course, at the end of March 2020, there was a huge amount of things being done to pump money into the market, to stabilize markets, and you had the biggest rally since 1929. There has not been one like that for a couple of life cycles, basically, for a lot of people. And the product kept on saying, stay out of the market, because the risk, remember, this is a risk management exercise. The fact that markets go up, I mean, this is not a trend following capability. So if it was, it would have jumped in and joined the trend. But it looks at the data, it saw the data was risky, and it decided to stay out of it, because the problem is, if you do participate in a big leg down, it is so much harder. We all know the whole, if you go down 20, you need 25 to come back, 33, you need 50 to come back. And obviously, if it's 50, you need 100 to come back, % growth. And the AI decided to stay out. However, there is something I think that is worth mentioning if you're not aware of that. There was an upgrade done. And from time to time, they do upgrades because they test stuff in a different software, different hardware on the engine from time to time. But they made an upgrade in September 2020. I can't recall the date. I think you implemented on the 23rd of September 2020, wasn't it, Alessandro? Maybe it's worthwhile just to explain, because there was a small change made, which has caused quite a big difference, as we can see from the numbers, post that.
Yeah, the improvements that we make really are every 3-year period. We make some small changes to really small changes, because the overall architecture of the software is being created over a number of years, and the philosophy is the same, but we make small changes to have some gradual improvements. One of which is related to the way the 600 decisions made by the AI traders are considered. So the way a signal is extracted. Before we had a head trader, AI head trader, which looks at the value of 600 and was ranking the 600 traders based on many different metrics, and through the ranking, it was giving a weight to the traders, to the predictors, and from which it was extracting a signal. Now, what happens sometimes, it might sound counterintuitive, but at certain times, Don, what happens is that the worst predictors or the worst systems, like the worst human traders, might do particularly well in a bad situation or in another investment period, while the best predictors or the best traders are not doing particularly well. So literally, the ranking metrics then create a distorted picture about who is doing what and how, and therefore we simplify that step in order to keep in consideration in the overall decision-making process all the decisions taken by the 600 and not by a subgroup, just in case something was going to be missed along the way, so that when there is time then to weight the decision, where is it coming from, all the various hypotheses are then considered and not just an extraction out of the 600. So all the various hypotheses are more or less considered, because all the families of traders or machine learning methods are equally considered in the decision-making process. So family of machine learning methods means literally looking at family of ways through which mathematics is used in order to analyze data. It's almost like saying the background of human traders. You have studied economics, someone else might have studied mechanical engineering, and another guy has studied history. Obviously, when these three guys look at the S&P 500, because of their background, they will come up with different hypotheses because it's obviously endemic in what they've studied before. And here, with respect to machine learning families, the difference in mathematics make the hypothesis considered in a different way, even if the outcome might be the same. So the way through which the predictions were weighted is now more representative of the various 600 hypotheses. So in a sense, today, if we have a similar scenario, it should be more reactive than before.
Okay. So last question. The fund is run by AI 100%, right? Is there any chance that the AI can go rogue or make bad decisions?
Can decide to take everybody on Mars and back multiple times. Yes.
Yeah.
The software can only operate.
Yeah.
The software cannot. No. The software can only operate within the investment guidelines provided by the manager or the strategy, which, with respect to this fund, are you can only operate using three instruments. Okay, the MSCI World Tracker, cash, and S&P futures, and you can only operate between 10 and 90%. So the software cannot decide to use leverage, because it cannot decide to say, okay, fine, you know what? I'm hitting the 90% exposure. I want to go higher. Okay, I can't go to 95% or 140% exposure. You can't. Mm-hmm. Equally, if the software says, all right, I want to reduce the level of my net exposure down to the minimum, that minimum is 10%. It can't go below 10. It can't go net short minus 30% because he might feel is the appropriate weight. He could only do that if the investment guidelines get changed, but it can't be done. the investment guidelines for the fund are fixed.
Also, the trades are executed by, well, humans. I mean,
Correct.
it doesn't have to be,
So
but
what
it just
happens
happens to be.
also, correct. So what happens also, there is no, the software doesn't execute the trade. So the software generates the signals which are related to the trades. These signals are sent on a weekly basis using a file to the traders. The traders, just in case, even if obviously it can't happen, just in case, check the decisions taken that respect the investment guidelines of the fund, and then execute the trades. That's why we have this switch between signal generated, traded, executed at the Monday close, and that's why Don, this is a fund that takes decisions every 5 days. Okay, it's an asset management, asset allocation, tactical asset allocation strategy. If you go shorter than that, it will become less tactical asset allocation and much more of a trading fund. Okay, whereby the software would have to take the decision and execute the decisions, because the more you get into trading, the more the time of the execution is key. Okay, so the faster you go, and then it will become critical that the software takes the decision and execute the decisions. It can't be done for this fund because it's a tactical asset allocation strategy whereby signals are generated, signals are checked, investment guidelines respected, traded, executed.
Mhm. All right. Yeah, I mean, we're over the 45-minute mark. So to our attendees, we'll just update with the fund fact sheets, its performance. Once again, thank you, Gideon and Alessandro. Thank you for your time. To everyone, have a great day, and we look forward to connecting with you again soon.
You're
Right.
welcome,
Thank you very
Don.
much,
Thank
guys.
you for having
Thank you for your
us.
time. Thank you.
Okay, guys.
Take
Bye.
care, everybody.